Hi friends, hope all your exams went really well. I have been getting questions on the AFM paper and students wanted my review as well as comment on some of the questions. I normally avoid commenting during your exam periods, so I'm recording this video on the next day after your AFM paper, but I'll upload this in YouTube only after all your papers get completed. I have been telling students that you should not discuss the paper after it is written. It will affect your flow. Also, for the balance paper, it will start impacting depending on a good performance or a bad performance. But now the exams are over. Time for you to take much needed rest for some time, and then we'll obviously start back with full energy depending on whether you have written one group or you have written both the groups. If you have written both the groups, obviously time for you to relax for a longer period. But if you have written one group, then you may have to come back for the other group. And in case your exams did not go well, if you're not very confident, then also you may have to start back. Let's quickly discuss the AFM review. I have gone through the paper. It is a simple and a easy paper, but not an extremely easy paper and all, because I could see comments where they have said it's an extremely easy paper and all. Yes, it's a simple, easy paper. I feel some students would have struggled in completing the paper. This is a struggle which some students could have had, but otherwise, predominantly the paper has come from what are the areas we expected, primarily from the priority material. Study material, I don't want to take any credit because it is from the study material. If I say it is covered in my theory book or question bank, it is indirectly covered in ICAI study material. Any paper which is from ICAI study material will find that any author's book 100% is covered, which is what you would see in predominantly in this. Most of the questions were similar except for 5B, 6A and 6B. These alone were little bit new with some extra adjustment. 5B had some extra adjustment. 6A and 6B. 6B is also very similar, but still some challenge could be there with question with students. And 6A, some extra reverse working element was added. Apart from that, I have told students to follow a block method. This is the block method I normally suggest. There's a block one, security valuation, business valuation, mergers and mutual fund. I expected 44 marks will come from this area. In exam, 48 marks have been asked from this area. Block 2, which is forex, derivatives and portfolio, 37 marks were expected. We have happily got 33 marks here. Theory chapters were there. I had in fact released one theory video where I had told you very clearly that if you're aiming for exemption, ignoring theory and reduce your mark to 50 or 55, and the exemption may not come. Theory is very critical. So theory got tested for 20 marks with one internal choice also being there. And I had told special focus given chapter 15, 7, 1 to 4, and all theory questions were from that chapter only. And your last block, which I normally tell to give lesser importance, is capital budgeting, international financial management, interest rate risk management, security analysis and risk management. Expected 25 marks, actual 17 marks. This is as per the block of the different blocks which I had introduced. If you see my priority question material, you will see this different blocks being given to you. I'll show you the priority material. In the priority material, we had given you these blocks saying that if you follow block wise preparation, maybe it'll make it easier for you to complete the preparation. And this was the historical. It is not that I have done some fancy analysis and all. Historical data, security valuation, business valuation, mergers and acquisition, mutual fund 17, 9, 7 and 11 put together 44 marks have been tested in the past, likely to happen in future. Forex, derivatives and portfolio, 37 marks have been tested. Then your special attention to 15, 7, 1 to 4 and at 25 marks for the last block. So going by the block of different chapters, if you had gone through the preparation using these blocks, block 1 and block 2 itself would have given you 81 marks of the practical questions. Theory questions, sorry, 81 marks, and theory questions 20 marks from those chapters. In case you had not done the block 4 also, it could have been easier. And I had also released a priority question material. There I could find that 80 marks out of 118, including the theory question. Okay, theory was 20 marks, were from that priority question list, and balance also were very similar to the priority question list, or they had come from not the priority question list, but maybe from the concepts which are covered in concept book. So this is a broad review. Paper is a scoring paper. Exemption can happen easily. Only challenge I could see is paper completion. Reason is 6 marks case scenario. So totally a student has to answer 5 questions, and thereafter two questions everywhere. So 15 questions have to be answered. Some students it can be a challenge and they could have struggled with paper completion. 15 questions you have to answer and theory have to be answered, but otherwise I feel it's a very scoring paper. And one another good thing is I could not see, I think this I'm telling after a very long time, I could not see any logical gaps in the question. There were no errors in the question. In fact, decimals working, they made it very, very clear in every question. So I think one good thing about the paper, or very, very good thing about the paper, is no ambiguity in the paper. I could not see any ambiguity in the paper. More or less crystal clear paper. If you have faced some ambiguity, you can let me know. But I did not see any ambiguity in the paper. So more or less straightforward paper without any ambiguity, without any ambiguity in the paper. Okay, quickly let's discuss the paper. Question 1 to 3. This was an option profit or loss calculation, similar to one of the study mat question or the question bank question. There we are buying a call option and a put option. Premium of 25 and 8 will be my expense, and call option will get exercised if the actual price is less than 750, sorry, more than 750. Put option will get exercised if the actual price is less than 600. I am not discussing much about it. You can look at the solution. This is the solution for question number 1. Nothing to discuss in this question because it has come from the exam only. If it is 820, call option will get exercised and we earn 70 into 100. 680 both will lapse. 500 put option will get exercised and 150 into 100 will be earned. And this is the net profit or loss. This is question number 1 to 3. 4 to 6 came from Forex chapter, which was testing on an area called bid and ask swap points concept and the premium or discount computation. They are given a spot exchange rate, 2 month swap point is given, 3 month swap point is given, calculation up to 4 decimal point. This is what I liked really about the paper. Every question they clearly mention how many decimals we have to calculate, because it is a normal challenge for students on the decimal working. Assume spot rate, and so I have to calculate on an average rate. What is average rate? Is normally the premium calculation is FR minus SR by SR into 12 by M into 100. Average rate means you have to take average of spot rate and forward rate in the denominator. Average of spot rate and forward rate. So for doing this, first you'll have to get the swap points. I have 2 month swap points, 3 month swap point. Using interpolation, I'll get 2 months and 15 days. Swap points are in ascending order. Add it to the spot exchange rate. After you do that, forward minus spot by spot in by spot plus forward average. Spot plus forward average. So you'll have to take the spot plus forward average in the denominator and calculate the premium. This is on question 4 to 6. These are your answers. Bid 0.0598, ask 0.0723, bid 105, ask 129, bid 84.2630, ask 85.6074. Again, a fairly simple question. Third question was on mergers and acquisition, where they have given data of the acquiring company and the target company. Two companies are there. Number of shares, MPS and P ratio. If you use this, you will get EPS. And if you use EPS and number of share, EPS and number of share, you will end up getting the PAT level of the company. We are going to acquire the other company by paying 80 lakh rupees, and we'll issue shares at 16. So 80 lakh divided by 16 is the number of shares issued, our usual format. This was given in the question. EPS reverse working, earnings after tax reverse working, add the total earning, number of shares 12 lakh plus another 5 lakh, EPS will come, NPS will remain same. They said NPS will be maintained. P multiple is balancing figure. P multiple is balancing figure. NPS will get maintained by the organization. EPS is going to be balancing figure. EPS will be balancing. So P multiple will be balancing figure. This is on question number 7 to 9, where P multiple is 15.38, two decimal answer. EPS before acquisition 0.8 and 2, and EPS after acquisition is 1.04. Question number 10 to 12, it is on sensitivity analysis, part of the capital budgeting chapter. This was part of my block 4. In case you had not prepared block 4, maybe you could have struggled a little bit. But question was again very simple. I don't know why they asked such a simple question. I have capital cost, sales less variable cost less fixed cost, sales less variable less fixed, which is 1 lakh 80 is the revenue, or sorry, is the cash flow. Cash flow into 3.169, cumulative PVF into 3.169, compare with 4 lakh 80,000 is the NPV of the project. Then NPV will keep changing. Cost of capital raised by 10%. What is 10%? Is original 10% plus 10 of 10%. 10 of 10%, it will become 11%. It will become 11%. So we have to calculate initial NPV and then a revised NPV, where cost of capital changes to 11%, NPV goes down by 13.14%. Initial capital cost raises by 10%, NPV goes down by 53%. Inflow goes down by 10%, NPV reduces by 63%. There were three requirements on this. What will be the percentage change in NPV? Sensitivity analysis was asked in the question. 13%, 53% and 63%. I am not discussing the entire question and all. I don't want to do all that. All are straightforward, simple question. The newer question alone, I may discuss a little bit more. 13 to 15, from the mutual fund chapter, again a question which is there in your ICAI study mat and the question bank. Question number 17 of chapter 8. I had issued 50 lakh worth of mutual funds. We'll have to do the cash flow calculation. We made all this investment, then we received dividend income, so that will increase the cash balance. Interest on 7% government security, 9% debenture, 10% debenture, all that is received, so keep adding them. And operating expenses are paid. So first thing you have to do is the cash calculation. Cash is 5 lakh 25,500. With the cash add equity share 25,000 shares into 175% of face value into 175, 7% government security as it is, 9% debenture as it is, 10% debenture is 90% of face value, and cash balance. This will give you the total asset value. Divide that by number of units, you will get NAV per unit. In that, remove the dividend component. So 5 lakh 10.951, straightforward again. So these were on the MCQ side. MCQ was relatively simpler. You could see the answers are these: 10.951, 525, 500, 57, 75, 500. These are the solutions to the MCQ questions. Now I get to the descriptive questions. In descriptive, we have asked question number 1A. I do have similar question in the material, but where some small changes I said. This is also a study mat question. Number of equity share, current market price, 10% debt, cash and cash equivalent. From the gross profit, I will remove indirect expense. I'll get EBITDA 7 lakh. From EBITDA, we will deduct depreciation. We will get EBIT. From EBIT, deduct interest. You will get EBT. Deduct tax. You will get EAT. And divide by number of equity share, you will get EPS. So requirements were cost of equity RF plus beta into RM minus RF, 14.2%. Earnings per share of the company from gross profit, get EBITDA, get EBIT, get EBT, get EAT, EPS 3.47. Part 3 will answer in some time. First, you have to do enterprise value. What is enterprise value? It's EBITDA. EBITDA into the EV to EBITDA multiple. EBITDA into the EV to EBITDA multiple. Applicable EBITDA multiple is 4 means EBITDA into the EBITDA multiple will give you enterprise value. It will ideally give enterprise value. ICAI if it does something else, I'm not sure, but this is the correct approach. That is 7 lakh into 4 is the enterprise value, and enterprise value is equal to equity plus debt minus cash. This will give you the equity value. Enterprise value is equal to equity. Enterprise value is 28 lakh. Equity, debt is debt in the question is 2 lakh, and cash is minus 5 lakh. So 5 lakh will go to the other side and you will get the value is 31 lakh. Get the value is 31 lakh. This is as far as question 1A is concerned. They have tested on enterprise value. They have tested on enterprise value, part of the business valuation topic. Question 1B, this is on hedging through forward contract. Again, question very crystal clear, mention how many decimal and all. I'm very happy with the paper. KK Limited operating in Japan made a sales to an Indian company. Payment has to be done 3 months from the date of invoice. It is 855 lakh equivalent. So today 855 lakh yen equal to 500 lakh INR. It will become 1.71 yen per INR. This is today's rate. This will go down by 10%. So 1.71 minus 10%. And the forward rate is given 1.68 yen per rupee. What is the gain or loss? Today, if you make the payment 500 lakh, later if you make the payment, it will be 1.71 minus 10%. So today payment is 500, later payment is 555.556. 1.71 minus 10%. The gap is the expected loss. The gap is the expected loss under the present situation. This is my expectation. I will have a loss of 55.556 lakh if I hedge it through forward contract. Then I will be having today payment 500, later payment is 855 by 1.68. If you take a forward contract, which is 508, again there is a loss. Again there is a loss, and ultimately we say we should take a forward contract because the loss will reduce. The loss will reduce from 55.556 lakh to 8.929 lakh. There is going to be reduction in loss. Question 1C came from chapter 15, business succession strategy, covered in fact even in the summary material. I had told students to even see the summary material and go to the exam. Even if you had seen that, that is also sufficient. In fact, you guys should comment on this video how many of you have made answered theory really well, because I think theory you would have answered, I'm very confident, really well if you have gone through that video I had told you and gone through the summary theory material. Next, question 2A. This is on valuation of the share. They have given an investor is holding 2000 share. Presently, the rate of dividend being paid by the company is 2.5, D0 paid by the company 20. Share is sold at 45 today's price. Some factors will change whether the investor should buy, hold, or sell the share. I will do an existing price calculation and a revised price calculation, fair price. Existing has no utility in the answer, but ICAI does existing and then they do revised, and solution will be based on the revised price. What is existing? RF plus beta into RM minus RF will give you cost of equity. So cost of equity is 17.8, growth rate is 4%, deduct that in the denominator, fair price 18 and then fair price 38, compared with 45, go ahead and sell it. Existing also sell it, revised also sell it. In both the scenario, we have to sell the share. Any place you find any calculation errors, you can let me know. I have double checked it. It shouldn't happen mostly. Next, 2B came from interest rate risk management chapter, where you have to do the FRA settlement amount. Fairly simple area again. FRA settlement amount 80 CR for a period of 3 months. I'll borrow. Today rate is 7%. I'm freezing it at 7.3%. That is the FRA amount. If the actual interest is 7.6%, if the actual interest is 7.6%, bank, I have to pay 7.6 to the place from where I take a loan. But I have frozen the rate at 7.3, so there will be a settlement inflow for me. I will get 0.3% inflow of 80 CR 3 months and discount this at the actual rate. Actual rate is 7.6 into 3 by 12. This is the amount I will receive. And in case it is 6.8, I will have to pay the amount. I will have to pay the amount because the FRA rate is 7.3%. All concept, other things you want to see, you please see it later. This video is not to explain in depth and all, it's just to discuss the answer quickly. 0.3% inflow for us, discounted at the actual rate, and this is 0.5% outflow discounted at the actual rate. 2C came from chapter 1, again a theory question which you should have been happy to see because it was part of the summary material again and part of the important priority list. EA, okay, this was on bond refunding. I have already received on the day of exam, I think some 15-20 students message me saying that they did not give discount rate in the question. No friend, discount rate is given in the question. If the problem is silent, discount rate is after tax cost of new debt. This is covered in our concept book. In fact, in my question bank, I have a problem like that also. After tax cost of new debt. What is new debt? 10% debenture after taxes 10 into 1 minus tax rate 8% is the discount rate after tax cost of new debt. After tax cost of new debt. I don't know, I have answered this to, and I did not answer to any student, but questions have come. They have asked me why is the discount rate not given? No, discount rate is given. It is after tax cost of new debt. Sorry, just a minute. After tax cost of new debt, balance is very simple. We have 600 lakh which we have to pay. I'll be issuing 600 lakh worth of debenture. 10 lakh is issue cost and premium on redemption of 12% debenture is 5%. So I'll have to pay extra 5%. 30, whatever premium I pay, I'll write it off on the old bond. Net there is an outflow of 34 and then interest at 12%, 10% tax benefit, and on the new bond there will be write off of flotation cost, and net I'll save 10 lakhs every year, and then we do NPV of bond refunding. Discount rate is not given after tax cost of new debt. After tax cost of new debt, be very clear, it is after tax cost of new debt. A question which I'm gonna a doubt which few students have asked. I did not clarify that time. Now you may get clarified with this. Okay, 3B was on dividend payout versus dividend reinvestment plan discussion. Dividend payout versus dividend reinvestment plan discussion. They have given a bond 17.5 is NAV 0, 18.9 is NAV 1, D1 1.5, CG1 1.2. So NAV 1 minus NAV 0, D1, CG1 divide by NAV 0 into 100 is the dividend payout answer. If you do reinvestment, 1.5 into 1.2, 1.5 into 1 point plus 1.2, 2.7 into 1000 is my dividend income. This I divide by the reinvestment NAV, get units to decimal, and final value is this. And my return is slightly better in the reinvestment plan. So reinvestment is better. I had told even in the class that this question may end up coming. Many times this has been tested. They tested it again. EC blockchain technology, again part of the priority list, but it also had an internal choice. Okay, not in this, not the other one has an internal choice. So 3C blockchain technology. So with this, the question 3 discussion is also over. 3A was challenged for few students because they were thinking that discount rate is not given. Discount rate is after tax cost of new debt. It is covered in our concept book also. I keep saying students that you have to prioritize reading concept book or concept charts just to show you, because unless you prioritize on the concept understanding, you will start struggling with suddenly a different question comes. What discount rate to be used for computing NPV? Use after tax cost of debt given. If not given, we need to use after tax cost of new debt. After tax cost of new debt. It's there in the charts book also, and it will be there even in the concept book. So question 3 is over. Question 4, again, I think I've got doubts from few students. I'll discuss it. They have given return, variance is given, beta is given, 50-50 weight, systematic and unsystematic risk calculation. Formula is very simple. Systematic risk is equal to beta of the security into beta of the security into variance of market. This will give you unsystematic risk. For portfolio risk, you have two approaches. Both will give same answer. There's a Markowitz approach and there's a Sharpe approach. Many students have messaged me saying that should I do this or should I do that? That's okay. This is Markowitz answer. Security 1, weight 1 square, security 2 standard deviation, and 2 weight of security 1, SD of security 1, weight of security 2, SD of security 2 into covariance. How will you get covariance? Beta of 1 into beta of 2 into variance of market. You get answer of 3.238. Sharpe approach, systematic risk of the portfolio plus unsystematic risk of the portfolio, again same answer, 3.238, 3.238, same answer. I think this there is an error, sorry, this will be 1.799. I feel there is an error here, 1.799. 3.238, 3.238, Markowitz and Sharpe approach, same answer, same answer. To variance is same, standard deviation is square root. I think this will clarify the doubt which few of the students have asked me. Should I use Markowitz approach or should I use Sharpe approach? Doesn't really matter. Doesn't really matter. In Markowitz, we use covariance. In Sharpe approach, we follow systematic risk plus the unsystematic. And if you change the composition, return goes down, risk goes up. Risk I have calculated using Markowitz. You can do any of them. I didn't want to do both again, so I did Markowitz. Anyone in exam, anyone is sufficient. Markowitz or Sharpe approach, both will give same answer. So this also few students ask me doubt. By now, I think your doubts would have got clarified, friends. Then next was on derivatives chapter, where they wanted us to calculate profit or loss on the different position taken. Shares purchased, price went down, loss. Shares sold and price went up, again loss, and we had to cover it through Nifty futures, complete hedge. So Nifty futures balancing figure is rupees 25,000. I bought Nifty futures and Nifty futures also price went down. I bought share, price went down, purchase negative 2,50,000 into negative, loss. Negative amount into plus 5, loss. 25,000 into negative, loss. So all the three places we are making a loss. This is also a straightforward simple question. 4C was from technical analysis chapter, that is your security analysis theory question. 4C had an internal choice, say risk management chapter, parameters to identify the currency risk. I think every chapter they have ended up asking one question. Those 5 priority chapters, they ended up asking one question from every chapter. Question 5A came from International Financial Management. This chapter, it is not a very tricky question and all, but maybe a time consuming question because a little bit of computation is needed. They have given cash flows in Nepalese currency and INR, and I evaluate all investment by using a discount rate and convert all the cash flow to Indian rupee at the forward rate and discount it at the Indian rate. They have given the base rate. Base rate is NC 1.6 for INR. NC is the price currency RH, and INR is the product currency RF. Some students made mistake here. Then the solution would have gone wrong. These are your forward rates. After getting the forward rates, you get the cash flow. And once the cash flow is calculated, you go ahead and calculate NPV. NPV is negative. We are going to reject the project. NPV is negative. We will reject the project. So this is as far as the NPV analysis of the project is concerned. We have got a negative NPV. We will reject the project. Again, a study mat question. Comes question 5B. This was a similar question where they added few extra adjustment. I may discuss this for maybe 5 to 6 minutes. Other question and all, only 2 minutes discussion. I made a lump sum investment with an entry load of 0.05. Entry load is extra payment on day zero. NAV appreciated by 13.6%. I got dividend of 5 rupees and I reinvested them at 25. So originally I purchased X units. Okay. I got dividend income. I got dividend income. What is dividend income? 5x, reinvested them at 25, and this was equal to 15,000 units. We will get the units invested. We'll get the units invested. I purchased X units. Dividend is 5 into X, 5x by 25, and this will give me number of units purchased. Then they are saying fund has charged an exit load. Investor is in 20% tax bracket. Inflation rate is added. Number of units purchased 12,500. NAV, what is the NAV is the reinvested at year end NAV is 25. So beginning is 25 divided by 113.6%. There's an appreciation of 13.6. So from the opening NAV, 13.6 extra is 25. So 25 divided by 113.6 opening NAV, and my investment is this. Opening investment is opening NAV plus the entry load. This is the amount I invested. Third part was a very good question. Appraise the return percentage and the real return percentage. Return percentage is nominal return, and there is a real return also, which is removing the inflation effect. What is nominal return? I sold 15,000 into 25, 1% exit load, because I'm redeeming it at the end of the year within 1 year. Technically, it's still within 1 year. Maybe if I know that exit load is going to happen, I may delay it by 1 day. But within 1 year, I'll pay 1%. I'll get an amount. So my amount on maturity is this. Investment is this. Gap is profit. On the profit, pay 20% tax. 20% tax. So I technically earn 76,400 after tax by investing 275, 750. This is called nominal return. This is technically called nominal return. 76,400 by 275, 750, technically called as nominal return. Then what is real return? Real return, again, you have to remember your different formula at different places. 1 plus nominal return is equal to 1 plus real return into 1 plus inflation rate. So nominal return is given, calculated 27.71. 1 plus real rate into 1 plus 0.045, inflation 4.5%, real rate is 22.21%. Real rate is 22.21%. I'm very happy with this question. 2 3 reasons for being happy. One is I could not see any ambiguous item there, and it tests your concept but not very tricky and all. It tests your concept understanding but not very tricky. I say did not create any ambiguity in the question. So good problem. 27 and 22%. Question 6a, it was a slightly reverse working question. If a student was able to think through smartly, they would have got the answer, else they could have struggled with this. I have a share which is priced at 192. Mr. Roni is planning to purchase the share for the purpose of he has taken the services of financial analyst before tax required return. Cost of debt, cost of preference, cost of equity before tax. Debt alone we have to do after tax. 8.6 into 0.7. 8.6 into 0.7. Debt alone we have to do after tax. 8.6 into 0.7 is the after tax for debt alone. Debt alone after tax. So cost of debt is 8.6 into 0.7. Cost of preference given in the question. Cost of preferences. This question I'm discussing again little bit in depth. Preference is 11%. Cost of equity is 13%. Weights given are 0.2, 0.3, 0.5. I do the multiplication of this. 2 decimal, 1.20 we can write. 2 decimal they wanted us to work. This is the WACC. 11% is the WACC. Market value of debt is given. Preference is given. FCFF for the year just ended. Year just ended is FCFF 0. No confusion at all. FCFF 1 will grow at the rate of 8%. So value of firm is equal to FCFF 1 divided by KO minus D. What is FCFF 1 is 125 plus 8% divided by 11% minus 8%. This will give you the value of firm. From the value of firm, deduct the value of debt, value of preference. So value of firm is there. Deduct both. Value of equity, fair value of share is 205. Market 192. Go ahead and buy. 205 is the fair value. Please go ahead and buy. If 205 is the fair value, market 192. Then assume you get the same value of equity as calculated in one. What is the equity value? 4105 million. 4105 million using the FCFE approach. And if the FCFE is expected to grow at the rate of 8.5%, so they're saying you calculate what is the FCFE. So FCFE1 is the numerator. KE minus G. KE is our cost of equity was 13% and growth rate is 8.5%. This will give me FCFE1, and then from the FCFE1 I'll get the FCFE0 for the year just ended. Very good question. 184 reduce it by 8.5%, 170.25 million. FCFE1 by KE minus G. FCFE1 divided by KE minus G. It's a slight reverse working, nothing very tricky and all. It was a slide. I would have happily answered question 6. I get to know many students did not answer question 6 because they found 6A. 6B also little bit they found it difficult, but when I read the question, you understand that this was the easiest of the lot. This question was the easiest of the lot. They made it little bit different wordings were done in the exam. So this is on the question 6A. Now I made an investment. I have invoiced, so I have a receivable of 75 lakh in a 1 year's time. My home currency is UK GBP. I have a receivable of 75 lakh. Receivable of 75 lakh. Borrowing present value of 75 lakh for 1 year, converting into GBP and repaying the loan out of eventual receipt. To put it very simply, money market hedge. Because in money market hedge, if you have a receivable, you will find out the present value of that is divided by the interest rate and end up taking a loan, convert into home currency, create a deposit. This is what I have done. 75 lakh loan taken, converted to GBP, deposit created, received from the customer, repaid the loan, and GBP along with interest. Money market hedge question. And second one is the more easier. That was just a forward contract. 75 lakh divided by 1.3128. We have higher inflow in alternative 2. We will take a forward contract. I felt last question as a very simple question. It was a money market hedge versus a forward contract. With this, we have discussed the paper, not an in-depth discussion, but I have discussed the entire paper. Anywhere, any doubts, any clarifications you have, you send me a message in WhatsApp or type it here. I think a time for you to enjoy your much needed break. Enjoy it and get back at the right time, depending on whether you're doing, you have another group pending or not. And if you're not confident, please start back in maybe another a week's time, not beyond that, because now the gap is not 6 months, it's only 4 months. Time will quickly go. By the time result comes and all, you will have very limited time available. Thank you, friends.